The S&P is down almost 7% combined in the last 2 days. This is a historically bad sell-off. I don't need to scour all the history to find out the few previous times that this has happened. This is historically bad. So I want to comment on it and I think what's going on. First, I want to say this is commentary and analysis and not investment advice. Feel free to reach out to me if you'd like to discuss working together or just to be put on my distribution list. All the stories are talking about the coronavirus being the cause of this. For example, here's the front page of the Wall Street Journal yesterday. And so, of course, we see lots of talk now about the coronavirus. You know, that is not unreasonable. However, financial markets, people involved in the financial markets have been all over this for weeks and weeks and weeks, okay, while the market was going up and up and up and making new all-time highs. And so financial markets have been watching this because China had an enormous number of people under quarantine and still does. And so obviously that has an effect on global trade. At the moment, there are still very few cases in the US. We're currently in the 50s in terms of numbers. There are about 40 of those came from the Diamond Princess cruise ship in Asia. There have been about 14 confirmed locally diagnosed cases. I think a big portion of those were people who had traveled to Wuhan, early on in this. So to have a number of infections in the low 50s here in the US, to put in context, I know it's not the flu. People talk about, there are a lot of people who jump up and down about saying don't compare it to the flu, all that stuff. But to put the numbers in perspective, about 10,000 people die every year of the flu. And here's a graphic that puts it somewhere between 8,000 and 20,000 people. So of course that's bad, but I'm willing to bet that over casual discussion in the last few months, without any context of coronavirus, you hadn't mentioned to a friend when you're out having a drink that, can you believe 10,000 people died of the flu? Okay, so still in the U.S., it's extremely small. I want to add an alternative narrative to this. The sell-off has also coincided with Bernie winning in Nevada in the weekend and also rising strongly in the polls. Okay, so he got a ton of press over the weekend on the back of his Nevada victory. He was on 60 Minutes. The press is starting to hammer him on the Castro qubits is not all bad. It's not all bad. And certainly not a stretch. Doesn't stretch the imagination to suspect that financial markets would not like the idea of a socialist president. Okay, so here's a graph to show how it's gone recently for Bernie as a Democratic frontrunner. Okay, so you could see the graph that he has been strongly rising within the last single-digit number of days. In addition to that, if we look at what Predicted says, this is similar to basically almost anything that you look at, we see that Trump is the frontrunner in many polls, but look at those two lines. The difference between Trump in the top line and Bernie below that is narrowing considerably. So even though Bernie hasn't won, if there's a possibility of something bad happening in the market will start to discount that. Okay, so China's been dealing with these quarantine issues for weeks, so why now? I think that's an important interplay. And of course, there's a relationship there too. To the extent that global growth slows down, that's a negative for an incumbent president trying to get reelected. And so that also adds a tailwind to Bernie also. So there is a little bit of a feedback mechanism there. Speaking of feedback mechanisms, we also need to think about the policy response that will be on order here. So obviously, this is bad for global trade, but the central banks around the world will respond with stimulus. I think it's getting more and more likely in the US we'll see a rate cut. If you take a look at this graph, it shows the market implied probability of Fed rate cuts. And you see as these lines go down, that represents the probabilities going up. Okay, so the likelihood of the Fed cutting rates is going up in the US. And we just saw yesterday and overnight, former Minneapolis Fed President Narayana Kocherlakota wrote an article in Bloomberg and also gave an interview where he argues that the Fed should be more aggressive and not wait to cut rates. He argues that the Fed is so close to being out of tools, and with interest rates so close to zero, the lower bound, the zero lower bound, that the Fed must be proactive given how little ammunition they have. I don't know whether they will or not, but he was a previous board member, and I think that's a totally reasonable perspective. I recently pointed out how the stock market and the real economy have been operating in a way that has a historically very low correlation. Okay, so the stock market has been driven much more by stimulus and financial engineering than it has been in the past. So I know. It sounds ridiculous to say that the way to deal with the coronavirus is by printing more money, right? But when you have a hammer, everything looks like a nail, and I think that's what we're going to see. I think it's also a good time to go back to what I've often been repeating from a financial market perspective, from an investment portfolio perspective, from your portfolio perspective, okay? That the best plan is the intersection of a plan that's a great plan that you can also stick with, okay? And that having a good plan with the medium to long-term outlook that's diversified within asset classes and across asset classes, and then stay the course and look for opportunities. I talked about this a little bit more in depth when I posted my recent comments titled How to Invest During a Recession, a question I get all the time. So let's take a look just right now at how some of those asset classes are performing, right? Because the stock market has gotten totally smoked. And I argued that look at how these other things have been a great diversifier in the past. So let's take a look, one, at long-term treasury bonds. Long-term treasury bonds have been very strong, and as the stock market has gotten smoked, long-term treasury bonds have continued to perform very well in this kind of environment, which is similar to how they've responded in the past. Also, similar instrument, treasury inflation-protected securities also have been performing very well. And look at gold also. Gold has done well, even though the dollar's been strong and has benefited from a safe haven type flow into the dollar. Gold has also been very strong. So if you have a portfolio now that's dominated by US stocks, you would feel pretty uncomfortable given what's happened in the market the last couple of days. But you would be much more comfortable if you were diversified across asset classes. Now, I think there is a smarter way to assemble a portfolio rather than just slapping all these components together, but I just mention these to give you an idea. Also, keep in mind that when people say that things can get a lot worse, they can also get a lot better. Okay, it takes a long time to develop a vaccine, so I don't think a vaccine is going to ride to the rescue here, but there are lots of existing antiviral drugs, and I'm sure they're doing lots of tests to see what, if anything, works for people who have caught the virus. So also, coronavirus is the virus that is typically the cold. The cold is a type of coronavirus. The coronavirus and the flu are seasonal. Okay, so there may be a seasonal component here also. I think it'll take many months before we really know what the effect here is in the US, if any. My biggest concern on the economic front is that since China production has slowed and they're selling less goods to us and to everyone else, this will weaken demand for the RMB, and China pegs the RMB to a basket of currencies, most prominently the dollar, and so perhaps the RMB peg becomes more vulnerable. That's it. Thanks for watching. Don't forget to subscribe and also hit the bell if you want to be notified when I post a new comment.